Hello, everyone. Good afternoon, and thank you for joining us. My name is Paul Bray. I'm a partner in our property and construction team. We did a very good session yesterday on property and construction related matters, and that is available on our website or for anyone who wants contact and details. But today, this is the second of our PKF Francis Clark 2024 property webinars, and today we're going to focus on property owners, including furnished holiday lets and structuring buy-to-lets. I'd like to welcome our speakers today. Heather Britton, a director in our tax team, will give a brief update on capital allowances and the opportunities for property owners to maximise their tax reliefs in 2024. She will then provide an update on the abolition of the tax regime for furnished holiday lets announced recently, which has been quite controversial. Then Jon Watson, a manager in our tax team, will discuss with Heather the ownership structures for buy-to-let property owners and whether incorporation is still an attractive option for such owners. And finally, Michelle Branch, a VAT manager in our team, will be speaking about the VAT implications of converting furnished holiday lets to residential property. If you've got any questions, you will see on the right-hand side, you can post them in the Q&A section, and we'll try and cover off as many of those as we possibly can at the end. And you'll be pleased to know we are aiming to finish by 1 o'clock. We did very well. We finished right on time yesterday. There is a handouts tab as well, which contains contact details for our speakers and links to the related insights and blogs on our website. But for now, I'll pass over to Heather to discuss capital allowances and furnished holiday lets. Thank you.
Perfect. Thank you, Paul, and good afternoon, everyone. So for the first of our sessions today, I'm going to look into just a brief update on what tax relief may be available if you own property as a capital asset. So this could be an asset that you use in your trade, or it could be a building that you let out to others. So first of all, tax relief is only available on certain types of capital expenditure, but that is available for expenditure against either your income tax or your corporation tax bill on certain items. So it's important to ensure that these reliefs are identified. For those of you operating through companies, you may have been aware that from 2021 to 2023, there was a period where you were allowed 130% tax relief. That was known as super deductions. And this was brought in before the corporation tax rate went up to 25% last April. So for the last year, we've had a regime which is known as full expensing, and this allows companies to get 100% tax relief on main pool plant and machinery expenditure. So that could be things like furniture, computers, alarm systems, on new expenditure in companies, and that's completely unrestricted. For those of you not operating via a company, and also for companies as well, you can claim a £1 million worth of annual investment allowance at 100%. So this is a very beneficial tax rate, which means a lot of people can claim complete tax relief on their expenditure in the year of expense. And this £1 million limit has been made permanent, which is great news because it was originally due to reduce to 200,000. So this was a great relief to many businesses. I've said that for qualifying items of plant and machinery, you can get the allowances above, but don't forget there is tax relief for new expenditure on structures and buildings. So this was introduced 4 or 5 years ago. So if you are having improvements to your premises or extensions or new builds, then don't forget you'll get this slower rate of allowances at 3%. And again, this can mean good tax relief in the year of spend and once the building's brought into use. And the overall thing to remember is if you're ever thinking of buying or selling, building or renovating a property, it's well worth getting tax advice in advance. We really can maximise the tax reliefs available. And before you buy and sell, these are really important planning points that's important to get in place, along with capital allowance planning, things like VAT. You want this transaction to work smoothly, so we'd strongly recommend advice in advance. And now if I may move along to the second of my topics, which is an update on the furnished holiday let tax regime. So back in the budget on the 6th of March this year, in the spring budget, it was announced that the existing tax rules would be abolished. But actually, I'd like to start off with saying, well, what's at stake here? What are the rules? And what could this mean for people that own furnished holiday lets? The existing rules have been around now for about 40 years. They were firstly brought in because most people are aware that investment income, so renting property, is taxed differently from trading income, and they're subject to different rules. But following some very difficult cases in the late 70s and early 80s, it came to light that actually many of these furnished holiday let owners fall slightly in between the rules. They're probably just about on the investment side of activity, but it was recognised they should get some special tax reliefs. So we effectively have a bit of a hybrid regime, and furnished holiday let owners are currently allowed to use some of the trading tax rules, which can be very beneficial. There was an Office of Tax Simplification review back in 2022, and amongst a whole myriad of things for property owners, the Office of Tax Simplification did question whether the existing rules should remain, but they said if they were to be abolished, they think that there should be some other reliefs and other rules brought in their place, or they could consider tweaking the existing rules. But the announcement back in March was simply that all the rules would be completely abolished for next April. And we still do not have draft legislation, and there has been no public consultation, which has led to great uncertainties for owners. So Francis Clark, along with many other bodies, have been lobbying, speaking to Treasury, and trying to put the points forwards for many of our clients. So in the next 10 to 15 minutes, I'll be trying to let you know what this really does mean for holiday let owners. Also touch what isn't changing, as there's many misconceptions, and then maybe give some options of what holiday let owners could consider doing now, given the uncertainty, and also bearing in mind, even if we do get draft legislation, this may not get into royal assent before we could have a potential change of government. So not only do we not know what the new rules will be exactly yet, there is no certainty that these will definitely go through. So the key tax benefits available to holiday let owners, and broadly speaking, you need to have actually let the property for 15 weeks a year. It needs to be available for commercial let for 30 weeks a year, and there's some rules for long-term letting that you need to comply with. But at the moment, if you qualify, you'd get 100% tax relief on capital allowances for furniture and fixtures in a holiday let. And this is expenditure on the original capital spend as well as on any replacement items. And the rules on the initial capital spend are what could be jeopardised here. Holiday let owners are currently allowed to deduct their interest in full against their taxable profits. So for those of you who have borrowings, you'll be used to deducting the mortgage interest expense before getting to your profit before tax. So whatever your tax rate is, you'll receive tax relief at your marginal rate of tax. And again, that could be going, which is very important for many. With capital gains tax currently on sale, there's a potential for a 10% tax rate on sale. Also, you could potentially gift the property, say to a family member, and hold over the gain. And also you could invest in a more expensive property and roll over that gain. So effectively, it's treated like a trading business. Many of our owners like the flexibility that holiday lets have in the fact that you can have flexibility for how you share the income. Often spouses don't have the same level of tax, so it's possible to put some of the profit to a lower paying tax owner, and that works very well. Going forwards, that flexibility could be removed, and many married couples or civil partners may end up having to share the profits 50-50 unless they take action. And finally, for those that like making pension contributions, you can use these profits to frank your pension contributions. So what are the key impacts on budget announcements? I think the most people that I've spoken to have been most concerned about the top three. So for capital allowances, one of the main concerns is when the rules change, are people going to have some of their existing allowances clawed back? And this is an area we've tried speaking to Treasury about and bringing concerns to them that there could be an immediate tax charge on some. Going forwards, there'll be no tax relief for the initial cost of fixtures and furniture in property, but there has been a misconception there'll be no tax relief for anything. But actually, these owners can still get tax relief, we appreciate, for replacements or repairs to the property going forwards. So for those set up, the main concern is, will there be a balancing charge? But also, we do think this will stifle investment in people looking to do holiday lets in the future. So for interest, I alluded to before, the individuals and partnerships going forwards, they won't be able to deduct the interest from their profits before calculating their tax. So when calculating tax, you'll be doing income less your other expenses to get to your profit before tax, and the tax will be calculated at that level. And only later on in the computation will you get 20% tax relief for your interest. Some have said, well, we're basic rate taxpayers, so that doesn't really matter. But actually, does the change to the computation push you into higher rates of tax? And for many, with the interest rates being relatively high at the moment, this could well mean you're in a different tax bracket. You could lose some child benefit, you could lose some personal allowance. So this is far more than just getting basic rate of tax. It's pushing people potentially into a higher level of tax at the same time. For those of you who have significant interest, I'd say it's well worth getting some advice on the impact to your computation. On the sale of property, there'll be a loss of the 10% rate of tax of sale. At the moment, if you operate as a qualifying holiday let for the last 2 years and you sell your business, then you can get a 10% rate of tax, which is relatively low. Going forwards, this is likely to be 24%, based on the residential tax rates for many. So we are getting questions at the moment as to whether people should sell, but also being mindful, there was an anti-forestalling rule announced on budget day to say that certain transactions would be caught. But as of yet, we have no detail of what that anti-forestalling will cover. We envisage it might try to stop certain things that the revenue think are slightly contrived or artificial, but we're hoping that those that truly sell to a third party by next April should still be able to get the tax reliefs, but we are still waiting for the legislation to confirm that. And also going forwards, there won't be the ability to hold over again on gift or to roll over into more expensive properties. So actually this raises questions. Should people be thinking about doing something now while the rules still exist, if they're not able to do it in future? Companies are still impacted, but maybe less so. And this is because companies can normally deduct their interest in full, even after these proposed changes. And that's because companies can deduct interest on residential or non-residential, i.e. commercial properties. So even if these properties are treated as residential following this change, most will be able to deduct their interest in full. So companies are less impacted, but they will still have other tax issues to consider, and they will still have the capital allowance issues I mentioned above. So also we've been asked by a lot of our clients what isn't changing, because I think a lot of the budget announcements and some of the correspondence I've seen coming back to people and their MPs have said this is all to create a level playing field with residential properties. It's an attempt to increase housing stock, whereas we've been pushing back on many of these points as this may not achieve the objective. So what is not changing is the VAT treatment. So currently, if you're letting holiday accommodation, then that is a standard rated supply. So you'd have to charge VAT at 20% if you're VAT registered. And from the 1st of April this year, the VAT threshold went up from 85,000, I believe, to 90,000. So there is a tiny bit of good news, but given the increases in prices and costs, some people may have already gone through that threshold, and people will still have to continue to charge VAT if they do now, even after the rule changes. So it's not a level playing field with residential property. Business rates don't look like they will be immediately impacted. So if you're subject to business rates, that treatment will still carry on unless there's any further changes to the rules. And finally, with inheritance tax, most owners should probably plan that these properties they hold as holiday lets will not qualify for relief from inheritance tax, and therefore, if they continue to own them, are likely to be subject to 40% inheritance tax in their estate unless they do some planning. So business property relief or business relief is unlikely to be available to most, as most will be seen to be carrying out an investment activity. And that is not likely to change under these new rules. And also, whether you hold them individually or a company, again, they're likely to be subject to inheritance tax. So if that's of interest, do speak to us as we can assist with succession planning. So moving on to what ideas could holiday let owners be considering? And I think there's a myriad of ideas out there. And what I would say is to every owner, these are very bespoke solutions and it's not a one size fits all. So it really does depend on your overall plans, your income requirements, your capital requirements, your succession plans, your financial plans, and how much money you need to live off out of this holiday let business. So first of all, I've seen many saying, well, I'll transfer my holiday let business to a limited company because then I'll get relief for my mortgage interest. But actually, that isn't always easy to achieve. There could be tax costs of getting into a company, and it's not always a tax efficient solution. And Jon and I, in our next conversation, will go on to look at some of those reasons why, to say that this isn't necessarily the best solution for some, but it may be something that certain businesses may wish to consider if it fits with their needs and the tax costs aren't too high. You could consider transferring ownership. So some of my clients are considering, if the rules change, then they may own the property in unequal proportions between spouses so that they can elect to be transferred on the beneficial ownership. So they may end up with one spouse owning 99% and one owning 1%. But this does require some further thought, may require further forms and further registrations, so should be entered into with a full understanding of the rules. Also, you may wish to take care because if there's a mortgage, then this could lead to stamp duty implications if you transfer a property with some debt. Other people might look to say, is now the point to consider succession planning? Should I gift my holiday lets to children? And again, that can be a very sensible solution to consider, but do take care because there are rules that if you haven't used it as a holiday let throughout, then not all of the gain can be held over. So very much a case of getting specific advice to your circumstances and understanding if there's tax payable. And if there is capital gains tax payable, it's not forgetting that now we're in a new regime where you need to report that tax to the revenue and pay the capital gains tax within 60 days. So this isn't something you can think about and give to your accountant and sort out the following 31st of January. This does need early planning to make sure that everything can be met. We would say to people, review capital allowance claims. Whether or not you do a significant big project now will partially depend on whether there's any clawback rules, but actually it's worth evaluating whether you've claimed what you can to date. If you're a person that likes to make pension contributions based on your profit, you might wish to take financial advice to say, actually, is now a good time to make some more pension contributions while you still can. And if you're thinking of selling, then do think carefully about timing. If these rules are going to be abolished from the 5th of April next year, putting something on the for sale on the market can take months and months. So it's something that needs careful planning to be able to meet any deadlines that may be coming. So that needs to be thought about in the myriad of all the options open to holiday let owners. So more than happy to speak to anyone after the webinar who may be going through planning what their options are. So a lot of people have said to me, what might happen next? And I know Jon Endicott and myself have been involved in calls to the Treasury. We've been involved with many discussions with MPs, as well as many of our clients. But I think it's important to note that an announcement made on budget day doesn't have any legal effect. So on its own, it's only showing an intention to change the rules. And indeed, there was an intention to change the rules back in 2009 when so many people lobbied, they actually changed their minds and didn't abolish furnished holiday let rules. We can by no means guarantee that will happen this time, but it's not a certainty. But when I last spoke to the Treasury, they were very much mindful that there will be no public consultation on this, but there may be a technical consultation on the legislation they're currently drafting. And this does need primary legislations for the rules to be abolished. So we do need a finance bill, and we do need it to get royal assent. But many of you will be mindful there's an election happening probably in the last half of this year. So actually, will this all go through? If there's a change of government, what might happen? Or could it get pushed through with little consideration? So I'd say it's worth considering the impact these new potential rules could have on you now, considering what are your options, and indeed whether you should do something now, but indeed not to do any knee-jerk reactions that haven't been fully thought through and aren't in line with your other planning, as there's a myriad of taxes that need to be considered. Inheritance tax, capital gains tax, income tax, stamp duty, land tax. These all need some thought. So we're happy to be here to help and guide people to understand their options and help make sensible decisions, some of which might be to carry on as you are now if the new rules don't impact you much. So that's what I'd like to say on the holiday let section. And now we're going to move on to having a discussion which will touch on some of these in a bit more detail, because we do get a lot of people that own residential property, and we often get the questions of what's the best way of structuring my ownership, and what are the key tax implications to consider. So Jon and I are now going to have a bit of a discussion around some of these topics to understand what our clients are asking us, some recent rule changes, and the kind of things that people might like to consider. So good afternoon, Jon. Perfect. I think the first question I had really is, what are the key tax challenges currently to those that are owning buy-to-let properties?
Yeah, so I think one of the main questions that we're getting quite frequently at the moment, and probably over recent years, is what is the best structure to hold let property? The two main options here are to hold it as individuals or via a limited company, although there are other options that you may consider depending on your circumstances. I think with people gradually building portfolios over a period of time, as often seems to be the case, what's the best option at the beginning might not be the best option going forwards and over the life of the business. So I think having a bit of forethought and giving consideration to the structure early in the days of the business is probably a good idea, and we would always suggest that end goals are borne in mind when deciding on that structure. One of the key drivers behind this, the sort of structuring discussion, is the mortgage interest relief restrictions that you mentioned earlier on. Providing that 20% income tax reducer rather than a deductible expense from rental profits for individuals holding residential lets. And that's having a key impact on numerous landlords, either by pushing them into higher tax brackets, eroding personal allowances, and also bringing people within the high income child benefit charge, increasing the overall tax burden as a result of the let properties. The reason behind this is obviously the fact that rather than reducing taxable profits, the relief for mortgage interest is coming off as a tax reducer at the end of the computation. Another big question we get asked, and you touched on it also earlier, is the relief available for the acquisition of fixtures and furnishings. The furnished holiday letting regime treats these slightly different, but with regard to ordinary residential lets, those costs of fixtures and furnishings at the outset, particularly on new properties, are not a deductible expense in computing taxable profits for a residential letting business. But going forwards, for replacement items or repairs, those are likely to be deductible expenses either as repairs or under the replacement of domestic items rules. I think one important point to raise here is that, obviously as time moves on, technologies improve and things such as, windows are no longer single glazed and the standard is double glazing, and HMRC do accept that if something is replaced with a modern day equivalent, that shouldn't constitute an improvement for those purposes. And I think the other point that you alluded to in relation to the apportionment of rental income between, particularly for married couples and people in civil partnerships, is that the default position for jointly held property is that it should be apportioned on a 50-50 basis. There is scope to change that, and the common way we see that happening is via a declaration of trust. But care does need to be exercised when implementing such a declaration, because it doesn't only change the income sharing ratio, but will also impact the capital ratio, so the right to proceeds on a sale. And if there is existing mortgage debt, as you mentioned, that can also potentially result in a stamp duty land tax charge.
So it sounds, Jon, like there's a number of challenges available, but I think the overall key takeaway is early planning is key. So if you're planning on buying a number, it's worth thinking about the end goal, because it can be quite expensive to move things around. So think about this early, rather than, we get a lot of people that say, I've amassed these properties over a number of years.
Yes.
Now I want to know what to do with them because I've got a number and I don't think my structure is correct. So I think early advice sounds like the key takeaway from that. So
Absolutely.
I think the next question I was going to ask, Jon, is it tax efficient to incorporate a property portfolio? Because I'm aware a lot of clients are concerned about the capital gains tax or stamp duty upfront costs.
Mm-hmm.
So maybe you could just give a quick overview of the main impacts there.
Yeah, absolutely. I mean, I suppose the basic answer to that question, is it tax efficient to incorporate, is that there is no one solution that fits every scenario. So it does really need to be considered on a case-by-case basis. And also, as I suggested earlier, with the end goals in mind. So from a tax perspective, the two main issues on incorporation are likely to be stamp duty land tax and capital gains tax. Now, looking at the stamp duty land tax point of view, for individuals or people who hold property jointly, the transfer to a connected company is likely to be considered to take place at not less than market value. So the stamp duty land tax charge incurred will be based on the market value of the property that's to be transferred. Now, when it comes to residential property, that's also likely to include the higher rates for additional dwellings, which adds an extra 3% duty on top of the normal residential rates. But for high value properties, so those valued at in excess of £500,000, also need to be aware of the 15% flat rate on transfers to companies. Although in a lot of circumstances for rental businesses, these will qualify for relief, as there are reliefs for properties used in a qualifying rental business. And on that point of higher value properties over £500,000, you will also need to consider any obligations that might arise under the annual tax for envelope dwellings. Again, there's likely to be reliefs, but there are reporting requirements and the penalties for late filing can be quite onerous. Historically, one of the sort of key reliefs that was utilised in reducing the tax burden on incorporation was multiple dwellings relief. But as some of you may already be aware, this is set to be abolished from the 31st of May this year. So that's removed kind of a key relief in reducing that stamp duty land tax burden on incorporation, meaning that for individuals transferring properties into a company, the tax is now going to be based on the aggregate consideration for all of the properties that are set to be transferred, which can, have a significant impact by pushing the consideration into higher tax brackets. There is a sort of a key part of the legislation with regard to transferring 6 or more dwellings, as this allows the application of the non-residential rates, which in high value transactions are generally more favourable, as they have a highest potential rate of 5% compared to a potential rate of up to 17% for transfers of residential property when you take into consideration the higher rates for additional dwellings at 3% and also potentially the non-resident surcharge of 2%. One of the another key issue is people incorporating partnerships, and there are special partnership provisions that potentially reduce the chargeable consideration for a transaction, so that there's no stamp duty land tax payable on a transfer from a partnership into a connected company. But these are quite complex rules, and there are lots of anti-avoidance measures that also need to be considered if that's an option that people are considering. Moving on to the capital gains tax treatment, the default treatment on ordinary residential lettings is that these will be deemed to take place at market value. So any gains are going to be subject to capital gains tax at a rate of 18% within a basic rate tax band, or for higher rate and additional rate taxpayers, that rate increases up to 24%. So the cost of capital gains tax can be quite significant. There is potential relief available from that capital gains tax liability in the form of incorporation relief, but there are quite strict requirements for that to apply. The key issue here is establishing that there is what's considered to be a business for the purposes of incorporation relief, and this can be quite a high threshold to reach for residential lettings. The sort of basic requirement on that front is that the business should have an active involvement of the owners, managing the property on a day-to-day basis, spending an adequate amount of time on managing those properties, finding tenants, etc. And also running the business on sound business principles with a view to a profit. There is some case law in this area that's helpful and does suggest a minimum requirement of numbers of hours, but generally speaking, passive letting with use of letting agents is unlikely to qualify for that relief. So the capital gains tax burden can be quite onerous on incorporation.
Perfect. Thanks, John. And I think another point there is we often find debt can cause issues on incorporation. Yes. So any debt needs to be properly novated. So I think if anyone's thinking of the route of incorporation, as John said, the stamp duty needs careful thought, the capital gains needs careful thought to see whether there'll be an upfront charge. And then how about, John, on an ongoing basis? Are there some scenarios where it's likely to be tax efficient on an ongoing basis for a rental business?
Yeah, so the first point that I would make there is that what really needs to be done is to weigh up the ongoing tax efficiency probably against the upfront costs of incorporation. And again, unfortunately, it is a case-by-case basis situation, and you do have to bear in mind future plans. So in terms of the practicalities of that, what needs to be considered is, is there a requirement of income from that rental business? Are you using this to sustain a lifestyle, or is this for the future as a means of retirement or something else? So for those requiring an immediate income from the rental business, incorporation is possibly not going to be the most tax efficient route, because this can often lead to a double tax charge in the form of corporation tax on any rental profits, as well as income tax on any distributions in the form of dividends. There is some scope, dependent on the level of involvement, to potentially pay a salary to potentially mitigate some of that extra tax burden, but you do have to bear in mind that that's likely to be subject to income tax in the hands of the individual, as well as national insurance contributions for both the employer and the employee, although there will be deductions as an expense for corporation tax purposes.
So I think the key takeaway there, John, is probably if people want to repay debt or invest or leave the money mainly reinvested, it may be more tax efficient. And for those that want to take a big chunk of it out, it may not.
Yeah, absolutely. So for people who are looking to reinvest and repay existing debt, taking advantage of that slightly lower rate of corporation tax, dependent on your marginal rate of income tax, could be a sensible choice. It leaves more profits available to pay down that debt or to reinvest in additional properties. I mean, one other key aspect, and you've already mentioned this with regard to furnished holiday lets, but the mortgage interest relief is another key component of incorporation, given that you can deduct the full amount of interest as an expense compared to the tax reducer afforded to individuals who are running holiday business. And obviously with the increased interest burden, that can be quite lucrative. And I suppose one final point that I would touch on in terms of incorporation, it is important to reflect on the practicalities of incorporation and what that entails. I think it's important to bear in mind that there are additional costs likely to be involved in terms of accountancy fees, increased administration in the form of filing statutory accounts year on year, as well as the complying with the director's responsibilities and also potential to be a personal guarantor on lending to the company, perhaps negating part of the benefit of being a company with the limited liability.
So tax is only part of the picture, and the
Absolutely,
other practicalities need to be considered.
Yeah.
So just one final point, Jon. I know I was asked this by a client earlier this week. Is property incorporation on HMRC's radar?
Well, the short answer to that question is yes, very much so. You may have seen in the news or various other sources that there are a number of schemes targeting particularly individual landlords aimed at restructuring those businesses to perhaps be more tax efficient. Unfortunately, not all of these schemes necessarily work, and there is a high profile case at the moment which has been highlighted on the HMRC tax avoidance spotlights that HMRC feel doesn't work and is put quite a number of landlords in a bit of a tricky situation with potentially increased tax liabilities and also unpaid tax liabilities from implementing the changes to their business. I suppose the other point as well is that given the mortgage interest relief restriction, that's kind of driven an additional number of incorporations. So HMRC is seeing more of these come across their desks, and by the nature of that, they are scrutinising this more closely, particularly given the judgmental nature of certain reliefs, such as incorporation relief. I mean, I wouldn't say this should dissuade people from considering incorporation as an option, but I think it does just emphasise the point that you do need to give it careful consideration and be comfortable with the tax consequences of that decision prior to any implementation.
Perfect. That's really helpful, because I think we've seen an increase in the revenue, of asking questions, but the other one is something called a nudge letter, where they'll literally write to everyone that's claimed, or a big proportion of taxpayers that have claimed reliefs, whether it's business asset disposal relief, incorporation relief, that literally says, we notice you claim this on your return. Are you sure you qualified? So the revenue aren't even inquiring into these. They're very much placing the onus back on people to re-question people that have claimed these reliefs. So it is difficult, and you can't get clearance as to whether you're a business. So
Yes,
it's important to get that advice. And as Jon said, there's a lot of things to think about here. So that's been really helpful. Thank you, Jon.
Thank you.
And I think the next section we're going to hand over to Michelle, who's going to discuss some of the topical VAT issues.
Thanks, Heather. For today, I'm just going to quickly run through the VAT liability of FHL suppliers and residential lettings, and the difference between the two, and also cover off the implications if property owners are looking to try and change the use of their properties from FHLs to residential. So as Heather mentioned, the suppliers for VAT purposes of FHLs are taxable at the standard rate. Residential lettings are exempt from VAT, and the recent changes that were, or proposed changes that have been announced, will not impact VAT for FHLs. So the difference between the two is the taxable suppliers of FHL properties means you're entitled to recover the input tax that you've incurred in relation to those properties. With residential exempt suppliers, you're not allowed to recover input tax that you've incurred in relation to any residential lettings. We are aware that some property owners might use the properties for both, so they might let during the peak season as FHLs and then during the low season as residential lettings, and so they might be partly exempt and have restricted recovery of input tax in relation to those small exempt suppliers for residential lettings. We've had a number of queries from clients since the budget, asking whether the what the VAT implications would be if they decide to change from furnished holiday lets to residential lettings. The implications here would be your income would change from taxable to exempt, and we would then need to look at the change of the use or intended use and whether that would be required to be repaid to HMRC. Given an example, if you've purchased a property which you're using for FHL purposes and you've spent more than £250,000 on that property plus VAT, it would become what's known as a capital goods scheme item. And a capital goods scheme item is monitored for a period of 10 years to monitor your use of that property. And it's a way for HMRC to claw back VAT if you change the use of that property. So just going through a very quick example of how the change in the use from an FHL into a residential property could impact you if your property was within that sort of range of expenditure having been incurred. And that could be on the purchase of the property or on refurbishment of a property. So in this example, Ben's business has incurred VAT on the conversion of a barn into a holiday let, and he's spent £250,000 plus VAT on the building works. In year one, he's used it for fully taxable income and claims all of the VAT he's incurred. In years 2 to 4, he remains fully taxable, and so he's not required to make any adjustments. But in year 5, he changes the use of the property from FHL to residential short hold tenancies. So in year 5, because the change of use, an adjustment will be required. In year 5, the use has been 0% taxable. So you have to look at how much of the input tax over the 10 years you're able to recover within that year. You would look at the 50,000 divided by 10 to get to your yearly adjustment. And so for Ben, in this example, he wouldn't have been entitled to recover anything in year 5, had already claimed 100%, so is now required to repay £5,000 of that VAT to HMRC. In years 6 to 10, if Ben continues to use the property for residential lettings, he would be required to carry on making an adjustment of £5,000 per year for the remaining years within the 10-year period. Another area to be careful of is if you change your use, if you change your intention before actually carrying out your first use. So with the CGS, it's once you've used the property and then changed the use. But regulations 108 and 109, they cover where you've intended to use something for a taxable purpose, but then before actually carrying out that intention, you change your intention and use it for an exempt purpose. So in those situations, HMRC would look to claw back all the VAT you've incurred. It wouldn't necessarily just be on what had been capitalised, but it would be all of your expenditure. The difference with Regulation 108 and 109 is that they will only look back for 6 years from when the attribution was first made. So it's not necessarily as wide-ranging as the capital goods scheme. So these are just a couple of things that would need to be considered if you were looking to change your use from taxable FHLs to residential exempt lettings. And then following on from that, we've also had, as Heather has also discussed, a number of people looking at perhaps selling properties now, and that would also have implications. The sale of a residential property is exempt. The sale of an FHL property that can be used for holiday accommodation will be taxable if it's new or where an option to tax has been notified. And the sale of an FHL property that is over 3 years old or does not have an option to tax will be exempt. Now, some properties might have restrictions that they can only be used for holiday lets, in which case, for that purposes, they're considered a commercial property, and they will therefore be exempt if over 3 years old without an option to tax. So again, the implications there are if you sell a property that you've been using as an FHL and you've spent money refurbishing that property, you will yet again be looking at falling within the capital goods scheme. The difference with a sale as opposed to the changing into rentals is that you would be required to repay the clawback amounts for all the remaining intervals in one period. So using the previous example, again, in year 5, rather than letting, the property is sold. In that example, Ben would then have 30,000 of VAT to repay to HMRC for years 5 to 10. And obviously for the business, that could be quite a big cash flow implication and cause potential issues. So some options, as I've briefly mentioned, you can notify an option to tax over a property where it can only be used as a holiday let. An option to tax doesn't take effect on a dwelling, but if it's considered a commercial property, then we would be able to notify an option to tax and make the sale of that property taxable, and this would then remove any clawback implications within the CGS. And the other option that could be worth pursuing would be seeing whether you could transfer the FHL business as a TOGC, so a VAT-free transfer of a going concern. This would also help with reducing any SDLT liability if rather than having to opt to tax a property and charge VAT on it. And then just going on to consider similar establishments. So the supply of holiday accommodation is taxable. A supply of residential accommodation is exempt. But HMRC consider supplies of similar establishments to holiday accommodation as also to be taxable. And there's a recent case, Royal Reed Limited, where they had this problem. So just to give you a very brief overview, Royal Reed owned 656 self-contained apartments. They let approximately 235 of those on a short-term basis. They had an associated company, CCS Limited, and that company provided optional services, maid services, dry cleaning, key replacements, luggage storage, linen replacement, and so on. HMRC said that there was only a single supply being made, and that supply was accommodation in a similar establishment, and said that those supplies should be taxable. Royal Reed argued that it was only supplying a residential property and it should be exempt, and that CCS was supplying services that were standard rated. But unfortunately, HMRC have argued, and it was agreed that it was just a single supply of accommodation which was similar to holiday accommodation, and that VAT should be charged. So again, just something else to perhaps consider if you are looking into moving from FHLs into residential lets, but might be providing some additional services alongside those lets, whether your supply would still be considered taxable. So hopefully that's given you a few ideas of where there could be potential VAT implications if you decide to change from FHL properties into residential lettings. And if you have any questions regarding those, we'd be happy to obviously help just talk through any options you're considering. And I will now pass you back to Paul.
Okay, thank you, and thank you to all our speakers today. I don't know if we haven't had any published questions come up to date, which is quite handy. We had a few questions yesterday on the construction one. We don't seem to have had any questions come up that I can see at the moment. But I think for me, other than thanking the presenters, just to pick up on the key points for today and the key takeaways. Heather's capital allowances update. The key there for me is take advice when buying, selling or renovating property, because on the one hand, you can maximise tax reliefs, capital allowances. On the other hand, you avoid problems such as VAT or my own favourite, the construction industry scheme catching people unawares. The Furnished holiday let gap is closed between what HMRC would be happy to call trade-in and what's investment income. But we are still though in an uncertain period with an election or royal assent following election of any proposals still to get through. And likewise, on the penultimate session, Incorporations aren't easy. We've done a few of them over the years, but they may well suit some circumstances. Lots of areas to consider, and potentially costly traps to avoid. There's still tax savings around on conventional furnished holiday let planning, either capital allowances or pension contributions, and still time to do that. And of course, there is still just about time to think about an incorporation. And finally, as regards the takeaway, as ever, there are some potentially complex and costly VAT implications of moving away from furnished holiday let to conventional residential letting. And as ever, we're in the team here of many years of experience that can help with this and can answer questions, which is very timely, as I have had a question arrive now. Is the first sale of a barn conversion to residential zero rated for VAT or exempt? That's probably a good one for Michelle.
Yes, it can be. It will depend on certain conditions being met, and that would be that the barn was considered commercial previously, and hasn't been used for residential purposes prior to the conversion, and that the conversion, once the property is converted, that it does meet HMRC's definitions of a dwelling. If it does meet those definitions, then yes, it should be zero rated for VAT.
Great. Thanks, Michelle. So just proving the point there. And as I said earlier, there's handouts available on the links on the screen. The recording will be sent across to those attending. But if anyone's got any specific questions from today, our contact details are on there, and we're more than happy to speak to anyone. We look forward to seeing some of you at our future tax or finance updates, either in person or online. And finally, it just leaves me to thank our speakers today and to thank all those of you that attended. Thank you very much.